Good afternoon, everybody. Uneducated Economist. I'm glad you guys are tuning in for part 4 of the monetary policy strategies for a low neutral interest rate world. A Federal Reserve Bank of New York speech come out November 30th, 2018 by John C. Williams, President and Chief Executive Officer. I am sorry, guys. I hope I don't mumble too much through this. It is very cold outside. We got the east winds blowing. Although it's a really nice day and it's kind of nice in the sun, the breeze coming through here is just bone chilling. So here we go. A simple example help us illustrate this problem. Oh, I guess I should kind of give you a little bit of context. So where we left off is that the Federal Reserve is basically admitting here that in case of a recession coming up, interest rates are so low that they cannot lower them any lower than their bound mark of zero, right? They're bound by zero at this point. And where they were left off was thinking, okay, so what do we do now that we have this interest rate so low, right? What kind of policies can we provide for the future in order to deal with this very low interest rate that we have on the Fed funds? And if a recession kicks in, we will not have the room to drop it because we are bound by zero. So that's kind of where we left off. Go back and watch 3. It explains it a lot better. I hope the wind doesn't keep just blowing this camera over. Okay, let's get this going. A simple example helps illustrate this problem. Say that 80% of the time the lower bound on interest rates does not constrain policy and the central banks aim for a 2% target inflation rate. During these good times, an inflation-targeted central bank aims to keep inflation near 2%. But 20% of the time the economy falls into recession that's severe enough that lower the bound constrains policy. Assume that during these periods, inflation averages only 1%. So 80% of the time, inflation averages 2%, and 20% of the time, it averages 1%. The resulting average rate of inflation is about 1.8%. As a consequence, inflation expectations are likely to become anchored at the long-run average of 1.8% below the desired 2% target. But that's not the end of the story. This downward shift in inflation expectation has a second-round effect on real interest rates, the economy, and inflation. When policy is constrained by the effective lower bound, the downward shift in inflation expectation raises the real interest rate, further diminishing the degree of monetary stimulus, making the downturn worse and reducing inflation even more. Even in times when policy is not constrained, the expectation of below target inflation in the future affects current decisions, putting additional downward pressure on inflation. In other words, monetary policy is always swimming upstream, fighting a current of too low inflation expectations that interferes with achieving the target inflation rate. A number of alternative monetary policy frameworks have been proposed that aim to tackle the problems associated with the lower bound on interest rates. Although they differ in many ways, it is useful to divide these proposals into 3 broad categories. First option is to maintain the basic framework of inflation targeting and rely on a combination of aggressive conventional and unconventional policy actions when facing economic downturns to limit the deleterious effects of a lower bound. These carry with it the risk of that inflation expectations become anchored at too low a level. And so I think I'm going to stop it right there. We'll talk about the second and third options and then the rest of the story here in the final part. But let's go back here and kind of do a quick review before here we go. Oh, my hands are just freezing, guys. Sorry. Okay. So it goes back here, and to be honest with you, this very first paragraph, it sounds like a really bad math teacher to me, right? He says 80% of the time the lower bound on interest rates does not constrain policy and the central bank aims for a 2% target inflation. And this is during good times, an inflation targeting central bank aims to keep inflation near 2%. I mean, he just kind of goes on and on. Basically what he is saying is that 100% of the time you're not going to be able to achieve this 2%. In fact, some of the time it's going to be under that 2%. And if it goes under 2%, you're not going to have 2% inflation, you're going to have under 2% inflation. That is ultimately what he said, but he puts it in this big long paragraph that seems really confusing, but it's not. It's just, he's basically saying that you're not going to be able to achieve the 2% inflation. At least you're only going to be hitting, at least in his words, an estimated 80% of the time. It's this complete BS that comes out of his mouth on it, but that's what he's saying, is that you're just not going to be able to achieve 2%. But that's not the end of the story. The downward shift in inflation expectations has a second round effect on real interest rates, the economy, and inflation. When policy is constrained by the effective lower bound, the downward shift in inflation expectation rises in the real interest rate, further diminishing the degree of monetary stimulus, making the downturn worse and reducing inflation even more. Even when policy is not constrained, the expectation of below target inflation in the future affects current decisions, putting additional downward pressure on inflation. In other words, monetary policy is always swimming upstream, fighting a current of too low inflation expectations that interferes with the achieving of the target inflation rate. So remember just a few weeks ago when, the term the Fed is loco, the Fed is loco for wanting to raise interest rates? That's what they mean by fighting a current of too low inflation expectations, right? So every time they go to raise interest rates, everybody freaks out saying, you can't do that, you're going to ruin the economy. And the whole time they're thinking, if we don't raise these interest rates, we're going to ruin the economy. Because if we don't have any room to move, then what are we going to do, right? And basically what they say by that is that the number of alternative monetary frameworks have been proposed that aim to tackle problems associated with the lower bound on interest. So he's thinking, okay, so there's some ideas that we have that we can effectively deal with the fact that we're not going to be able to produce enough inflation because we're bound by this zero, right? And then although they differ in many ways, it is useful to divide these proposals into three broad categories. The first is to maintain the basic framework of inflation targeting. So they want to be able to say, okay, we need inflation at 2%. How do we do that? And we're going to rely on a combination of aggressive conventional and unconventional policy actions when facing economic downturns to limit the deleterious effects of the lower bound. And that is a new word for me, deleterious. I had never heard that word before, at least I never kind of registered what that was. And so I looked that one up, and basically it has the way I kind of found it is that it's a long-term detrimental effect, right? And a good way to do it is, at least if you, the description I found in Google was that the divorce had a deleterious effect on the kids. Okay, does that kind of make sense? How it has this detrimental effect, and that's what he just said here, right? This combination of aggressive conventional and unconventional policies when facing economic downturns to limit the deleterious effects of the lower bound, right? So he's saying that lower bound will have detrimental effects, and they are going to come up with some unconventional aggressive policies to deal with that. This carries with it the risk that inflation expectation become anchored at too low a level. And basically, if they say that they are going to go and use this unconventional, aggressive policy action that may cause a detrimental risk to the inflation expectations, and it'll be anchored too low, sounds a little bit to me like negative interest rates. All right, thank you guys for tuning in to part 4. Come back for part 5 and the conclusion of the monetary policy strategies for a low neutral interest rate world. Thank you very much, guys. Having a great day. Oh, I want to show you something here. See this right here? This boat. Let me take you over there real quick and see if I can get through the trees. So right there, that sailboat right there, that guy, he lives on that boat. That's where he lives 24/7, right? And he has that little green kayak, right? And he paddles that green kayak in, and he gets his groceries and does that stuff. He does his shopping. Pretty cool, huh? All right, talk to you guys later.